All right, let's dive into a real head-scratcher today. We're looking at NIQ Global Intelligence's Q3 2025 earnings. Now, on paper, this thing looked pretty good, but the way the stock traded, whoa, that told a completely different story.
So this is the big question, right? NIQ comes out, beats expectations, even raises their guidance for the year. I mean, that's usually the perfect recipe for a stock to pop. But it didn't. It actually closed down. So what in the world happened? Let's get into it.
Okay, first things first, let's just rip the Band-Aid off and look at the headline numbers, because this is really where you start to see the two competing stories here. The good and, well, the not so good.
And here it is, laid out plain and simple. You can see it's a total split decision. Revenue, a solid beat. Awesome. Adjusted EPS, pretty much right in line with what Wall Street was looking for. No surprises there. But then you look at the GAAP EPS. Oof, that's a pretty big miss. And that, right there, is clue number one for why the market got a little spooked.
So let's start with the good stuff, the top line. Revenue topped $1 billion, which was about $18 million more than expected. And this wasn't just some one-off thing. It was driven by really solid organic growth, 5.8%. And get this, that's the sixth quarter in a row they've grown over 5%. You just can't argue with that. It's a clean operational win.
But here's the other side of that coin. That GAAP number, the one that follows all the official accounting rules, it showed a net loss of almost $200 million. That's a 17-cent miss versus the consensus. And a big red number like that, it has a way of grabbing all the attention and just completely overshadowing the good news we just talked about.
So you'd think management would be on the defensive, right? Nope. They came out swinging with a super confident, really bullish story. Their argument was basically, hey, forget that GAAP number for a second. This quarter is absolute proof that our big transformation plan is firing on all cylinders.
And you can hear it right from the CEO, Jim Peck. He basically said this was another strong quarter and that their transformation is finally showing up where it counts: revenue, margins, and free cash flow. He's practically begging investors to look through all the accounting mess and see the real, fundamental progress happening underneath.
And they brought the receipts to back it up. They pointed to that consistent growth we mentioned. They highlighted that their adjusted EBITDA margins expanded by 300 basis points. That's huge. Then there's the free cash flow, which was a massive $224 million. They talked up their AI integration, how it's making their data moat even wider. And to top it all off, they raised their guidance for the full year. I mean, that's the bull case in a nutshell.
But investors? Yeah, they were looking somewhere else completely.
So let's pivot and look at the market's reaction. We need to unpack exactly what happened to the stock and dig into the bear case that clearly won the day.
This chart right here is a perfect picture of the day's drama. It's what we call a spike and fade. See that? The stock shot up over 7% right at the opening bell. Traders love the revenue beat and the guidance raise. But that optimism just evaporated. A huge wave of selling came in, wiped out all the gains, and then some, pushing the stock to close in the red. And look at the volume, almost 3 times the normal amount. A lot of people changed their minds that day. So what were the bears so worried about? Well, it boils down to a few key things. First, that big GAAP loss we keep talking about. It's just persistent. Second, the company's carrying a ton of debt, a multi-billion-dollar hangover from its days under private equity ownership. And finally, you just have to look at the stock's track record since the IPO. It's been a rough ride, still down about 35% from its offering price, and it's been lagging the broader market.
And all of this really just sets the stage for the bigger, long-term story here, which is this battle over NIQ's identity. This earnings report, it wasn't just about Q3. No way. It was more like a vote, a referendum on whether Wall Street actually believes in the company's big strategic turnaround.
And this is the core conflict right here. You've got the old narrative. NIQ is this highly leveraged post-private equity carve-out with super messy accounting. It's complicated. Then you have the new narrative that management is desperately trying to sell, that NIQ is now a scaled, AI-driven data machine for the biggest consumer and retail companies in the world. They're basically saying, hey, forget what we were, look at what we're becoming. And to be fair, they've been hitting some major milestones on this journey. Back in 2023, they merged with GFK, which gave them incredible scale. Then, in July of this year, they raised over $1 billion in their IPO specifically to start paying down that debt. And this quarter, Q3, was supposed to be the proof of concept, the moment they showed everyone that the model works, that the cash flow and margins are really improving. It's all part of their plan to get to those mid-20s EBITDA margins by 2026.
All right, so we've heard the bull case, we've heard the bear case. Now let's put it all together. What does this mean going forward?
It's time for our take, the next call. Okay, here's how we see it playing out. Step 1, the next quarter. We fully expect NIQ to meet or maybe even slightly beat their raised guidance. The operational momentum feels real. Step 2, what's the stock going to do? Well, it's probably going to be stuck in a tug of war for a while. The bulls will be cheering the transformation story and the cash flow, while the bears will keep pointing to that giant pile of debt. So expect it to be range-bound. Which of course brings us to step 3, our final rating.
Our rating on NIQ is market perform. Look, the turnaround story is compelling, and you can't deny that management is executing on the operational side. But that balance sheet issue, it's a huge overhang, and you just can't ignore it. The market is going to need a lot more proof. We're talking several more quarters of killer free cash flow and real meaningful debt reduction before it fully gets on board. It's the definition of a show-me story.
All right, and before we wrap up, the usual disclaimer.
Just a quick reminder, everyone, this is for informational purposes only. It is not financial advice.